If you look at the recent share price chart for our three banks, you realize that they are diverging, correct? DBS year to date up 25%. OCBC not too bad, 12%. UOB minus 6%. This is as of mid of November, and you see that the difference between DBS and UOB is now more than 30%, correct, if you pick the wrong one. So what exactly is going on? Is DBS overvalued? Or conversely, is UOB a great value buy right now? Today, I'll be answering that for you. Hi guys, welcome back. Without further ado, let me explain to you what has happened in the three banks' latest results. Because if you were to understand the fundamentals, you kind of understand why the share price is reacting like that. This is a quick screenshot of the three banks from today's sponsor Longbridge, and more of them later. If you are an existing shareholder, do know again, this is not a buy or sell recommendation. My objective is purely to educate you on what I see in the books so that you get more prepared when you read the headlines and make your own investment decisions. So without further ado, let's go with DBS first. How about that? Firstly, Philips Securities has this report. DBS Group capital returns dividends until 2027. That's good news. In its recent third quarter earnings, there was $3 billion and above estimates. Long story short, the dividends will continue until 2027, and market typically likes that. NII, which is net interest income, that has dropped 1% year on year. As always, banks, the biggest revenue pie is interest income. So this dropping a little bit is actually substituted by the gain in revenues observed in wealth management fees. That has grown by 22%. Management has also guided for next year to be below this year. Interest rates are coming down and naturally impacts banks' profitability. But overall, there are positives, especially from the wealth management side. Don't worry, all these numbers later I'll consolidate into a summary table for you. How about that? So stay tuned right to the very end. Wealth management fees gone up 31% year on year. AUM, which is asset under management, $474 billion, 18% up year on year. I'm doing slightly better. I'm up 100% year on year for my wealth management business, as you can see over here. So I do run a wealth advisory practice. When markets are good, of course, it's easy to get interesting investments, but my strength always is in retirement planning and using investments as just a vehicle to get to retirement goals. Links below if you're curious to find a bit more. Loan-related fees for DBS gone up 25% year on year. As a result, net fee income is up 22% year on year. So let's plot this first into our table. Net interest income, it has dropped in third quarter to 1.96%. Growth of wealth fees, 31%. Strong numbers, and that's why Philips Securities has a target price of $58 for DBS. Again, target prices take with a pinch of salt. When bull markets come, target prices keep rising. When bear markets come, target prices keep cutting also. The best way to make money is to stay long term, and understanding the fundamentals allows you to stay the course and add appropriately. To buy any stock, very simple. Open your Longbridge account today. Don't worry, it's very simple to use and everything will be on your mobile phone. So this is actually my account, and if you are interested in any stock, simply add it to your watch list via this add button. And once you fund your account, you're ready to start investing. Simply click on the buy button, add in the quantity that you want, and it's just that simple to use. The good part when you have your Longbridge account is that you not only can buy Singapore stocks, you can also buy Hong Kong stocks and US stocks all in one place. Longbridge has one of the lowest brokerage fees in markets right now, $0 commission charges for Singapore, Hong Kong and US stock purchases. And there's a current promotion for you especially when you use my referral links below. When you deposit $2,000, you'll be given an $18 cash coupon and a 12% interest booster for 90 days. When you maintain the account for 30 days and do 3 buy trades, you also get an additional $40 of Nvidia shares and $40 of Apple shares. That is in the tier 1. And if you have a bigger amount, look out for tier 2, whereby depositing $10,000 and maintaining it for 90 days, with completing 5 buy trades, you will get $135 of Nvidia shares and $135 of Apple shares. And if you are a bigger investor, look for tier 3, whereby you can qualify up to $800 worth of welcome rewards. So what are you waiting for? Sign up your Longbridge account with my referral links below and become a better investor. Let's move on to the second bank for today, who is OCBC. DBS has a research on it, which is titled Dividend Policy, a Potential Re-Rating Catalyst. So OCBC's stock price jump might be because analysts are expecting them to pay fatter dividends for next year. Revenue was flat year on year, but net profit in total came in at $1.9+ billion, which is the highest quarterly earnings over the last 5 quarters. So new record high in total profitability. Same thing, the positives in wealth management is gone up by 53%. Wow. By the way, OCBC's wealth management private arm is Bank of Singapore. I don't know if you know it or not. Obviously, the high net worth space, a lot of money is flowing in. Singapore is opening up a lot of family offices, and that's one of the tailwinds across all 3 banks. Wealth management AUM is up 18% year on year to $336 billion, and therefore total fee income has rose 34% year on year, and the main driver of earnings. Interesting to note also on their wealth management arm, all wealth segments saw growth, not only in private banking. There were inflows from Europe into Dubai, along with broad-based inflows into Singapore from Greater China and Indonesia. Indonesia is where OCBC has acquired somebody new, who is actually PT Bank Commonwealth for 200 million last year. So I guess it's to bring affluent and high net worth space into the Singapore banking system. Back to the point on non-interest income for OCBC, Great Eastern saw improved investment performances, and one of the key benefits of OCBC is its bigger weightage into insurance arm, which is a lot more stable. So if you were to pull up our chart now, we can plot OCBC's net interest margins lower than DBS because DBS possibly has done better hedges. The loan profile is also slightly different. And OCBC has even done better on the wealth management fees, up 35% year on year. Hence, DBS Research has a target price for OCBC of $19.80. As always, if you have questions, leave in the comment sections. I'll next move on to UOB. Heads up first, not too good news, and I'll explain why. I put this up from RHB's research. Loan provision coverage build up dampens earnings. UOB's 2026 outlook suggests a modest operating backdrop ahead, but with credit costs expected to normalize, this should lead to a decent rebound in earnings. That sounds good, but mainly, third quarter 2025 actually missed earnings because of a higher than expected credit cost due to a build-up of performing loan coverage. Banks, they make money through loans, correct? And when there's risk that loan will default, they have to make adjustments and prepare for buffers. Let's drill down to details. Third quarter miss, when net profit was 443 million, that was a 67% quarter-on-quarter drop. Wow. That's why markets got spooked out, correct? It's mainly because they have made provisions which impacts the profits. From my understanding, in future, if the provisions for bad debts and losses do not materialize, yes, it is true that they can revise that loan provision back into the profitability. But as of now, this hit has been taken. Credit cost has jumped 134 basis points due to a preventive 615 million general provision. And when I looked into their presentation, I saw this. Not seen across in OCBC and UOB. And through my experience reading a lot of presentations, when they highlight something like this, typically it's not too good news. Typically it's serious. And if we draw deeper, we realize that the credit cost has jumped, particularly in third quarter 2025. You see that general allowance on loans and specific allowance on loans have ballooned up. Something must have gone wrong, correct? Or their antennas have sensed possible problems. And if we dig further into the appendix, we realize that Greater China has seen an increasing amount of general allowance. The non-performing loans ratio has inched up from 2% 1 year ago all the way to 3.1% already. Is this related to China's officers not doing well? I would think so. And I also think US is seeing a similar problem, if not worse. Non-performing loans for US has inched up from 2.4% to 4%. By the way, UOB and OCBC are at 1+%. 3-4%, as you can see over here, these are big numbers in comparison. If you read around, you realize that US commercial has issues because unlike Singapore, the return back to office policy is not as strong. There are a lot of vacant offices which have no rent, which impacts the value of the property. And when you have a loan tied to the commercial property, value drop means either top up equity or you have to take a haircut. So now you understand banks, they have risk also. The price to book ratio reflects the quality of the books, and that is also why UOB has right now the lowest price to book ratio across our 3 banks. If you pull up the summary table over here, you realize that their net interest margin is the lowest across all 3 at 1.82% only. And their growth, and also I realized their growth in wealth management fees at 19.2% is also the lowest. I expand the summary table for you to see with credit costs as well as ROE. By the way, I built this up for you. Smash the like button if you appreciate the effort. Share it with someone who's also keen to invest in the banks so that they understand why DBS and OCBC are rallying while UOB currently is faltering. Green for DBS because that has dropped with their reduction in provisions. OCBC quarter on quarter has actually inched up slightly. Not too material, but UOB, as you can see over here, the credit cost is the highest by far across the 3 banks. If we map return on equity, you realize DBS is the shining star, correct? 17.1%. OCBC, not too bad, 13.4%. UOB in latest presentation didn't even put the ROE there. I had to infer, and first half was 12.3%. Maybe because it's one-off provision, something like that, that's why the ROE is looking very out of whack. But even using first half ROE, UOB's numbers look the worst across all 3. I used to think that our 3 banks are very, very similar. But once I present numbers like this, it's quite clear why DBS is a premium, correct? Again, this is latest quarter. As investors, we are looking 1 year ahead, 10 years ahead. Maybe this is just a blip for UOB. Maybe this is just a short-term outperformance for DBS. We don't know. You have to make your call, and hopefully I give you enough information to spice up where you should go and do your own investigation. But wait, I have even more information, more summaries to show you to make informed decisions. I've built up this table further to show you the fee income, which is the salvation point for all our 3 banks because net interest income is dropping, correct? Their fee income through credit cards, through wealth management, through insurance is the way to replace profitability. And I've also here pieced on dividends so that you can quickly see what's going on. And I've also pieced on certain comments for you to understand in a snapshot. If you like, take a screenshot of this, share with your friends. And yes, as always, smash on subscribe because I'll be producing content like this to help you in your investment and financial journey in the years ahead. Thank you very much, and let me explain to you the differences. DBS fee income growth 22%, the highest across all 3 banks. Coupled with the net interest margin being the strongest, it is no wonder that they have been able to keep profitability the best across all 3. Dividends, they've signaled it to be strong, and you can see over here is 60 cents, normal dividend per quarter, that's why I put times 4 there, and 15 cents special dividend, up to 2026. Then OCBC, you see over here fee income growth 15%, second place. Dividends per share, they pay half yearly, that's why I put there 41 cents times 2. They've also a special dividend of 16 cents. Now what you heard so far is OCBC has a chance of increasing this, and that could be a catalyst for its share price. Last but not least, UOB, fee income growth the weakest of the 3 at 10% only, possibly unable to replace even its net interest income. Dividends was at 92 cents, but this latest is at 85 cents, and they've also given a 50 cent special dividend. While dividends are shook, it shouldn't be the only way to pick who of the 3 you should invest. It should also be based on price. It should also be based on its prospects. These are some polling results for my Telegram group, which I'll also leave links below for you to join in. Hopefully I've delivered a message to you today that shows you transparently all these 3 banks, how they fare and why market is reacting differently for DBS and OCBC versus UOB. Thank you very much for listening right at the very end. Check out this previous video I have, and this one in particular, why I'll invest in these companies rather than banks. See you in the episode 2. Take care as always. Goodbye.